Okay, let us look at the format for income statement for retail business. We have some differences here. For retail business, the main income will be sales, yeah. And then we have cost of sale represent the inventory sold, the value of inventory sold during the period. Okay. In our previous example, we have 4,800. So this is our sales. The cost of sale is 3,000. This is the value of inventory sold during the period. And then sales less cost of sale equal to gross profit. This is where you have 1,800. Your sales minus your cost of sales. Okay, it's very easy. And then from this gross profit, you're going to minus all your expenses. You're going to deduct all your expenses. So we need to regroup, our expenses to three categories: selling and distribution expense, anything to do with selling, for example, marketing, advertising, transportation, maybe fuels, this fall under selling. Yeah. Second is administrative expense, maybe the office, the rental, the computer, depreciation, all this fall under administrative expense. And finance expense, if you borrow money from the bank, you have interest expense. So this fall under finance expense. So we have sales minus cost of sale, you get your gross profit, and gross profit minus all expenses. But I want you to group that expense into three categories: selling and distribution, administrative expense, and finance expense. So this is the example, the basic example without the grouping. We have sales less gross profit, and then if you have any other profit, other income, you add other income, then minus expenses. Okay, so that is the format. We're going to do more exercises on that later on, yeah? Okay. Let us record how to record sales. How to record sales. Sale is revenue. Sale is revenue. So for revenue, increase in revenue, debit, credit, reduce in revenue, debit. So how to record sale? This is number one. If you receive the money, okay, the cash, immediately when you sell the item to your customer, you're going to debit your cash. This is debit your cash because your cash increase, and then you're going to credit your sales. This is credit, mean increase in cash, increase in revenue. Okay, debit cash, credit sales. But if you don't get the money, you give a credit to your customer, they promise you to pay, maybe you grant them credit for 3 weeks. So you're not going to record it cash for the time being, you're going to put it as accounts receivable. Accounts receivable. So debit account receivable 1980, for example, credit sales 1980. So this is the first transaction. Anything to do with sales, debit cash or account receivable, and credit sales. If your customer return the item to you, this is number two. If your customer return the item to you, so what you should do is you're going to create a new account. You don't use the sales accounts. You use a sales return and allowances. Call it sales return and allowances debit, and you're going to reduce your account receivable credit. Your account receivable asset reduce, your revenue reduce. We don't use sale, but we create another special account. We call it as sales return, or maybe sales return and allowances as a contra account for revenue. So this is the contra accounts for revenue. So when you derive your calculation later on, you're going to subtract these accounts from sales account in the account statement. So this is transaction number two. Sales is revenue plus and minus. So when they return the goods to you, there's some defect on the goods. You don't do it here, but you create another accounts, we call it as sales return and allowances debit and minus. So this is a contra accounts for that. Why did I credit? Why did I credit account receivable? Because account receivable, when they return the goods to you, you don't expect to receive the money anymore. For example, if you sold 100 unit to them, yeah, it costs you 100 times 80, 8,000. When they return the goods, maybe 30 units back to you, you don't expect to receive this 8,000. The amount that you're going to receive reduce. That's why you only pay you. That's why you have to reduce your accounts. Yeah, you have to reduce your account receivable account. Increase in account receivable debit, decrease in account receivable credit. Sales return and allowances. So this is the common one. Sometimes you give discount to your customer if they make early payment. So we have this credit term. Let me introduce you what is this credit term. 2 stroke 10 and stroke 30. 2 is for 2%. This 2 is for 2% discount. 10 is for 10 days, 10 days, and is 30. So the maximum number of days is 30. So if you make payment, if your customer make payment within 10 days, you're going to give them 2% discount, mean less payment. You're going to give them discount. And they must make payment not before, at least before 30 years, 30 days. Yeah, within 30 days. So this is the period of credit given to your customer. So if your customer paid early, they pay less. So that is the good thing. So you can receive your money quickly, and then you can use the money to buy more stock. So this is a mechanism to encourage our customer to make early payment. So in this case, if they make payment 1,000, if they make payment, this is 1,100. This is your account receivable. Okay, so they don't have to pay 1,100 in full. They only pay 98%. That is only pay 1,078, and then we give them discount $22. $22 come from 1,100 multiplies by 2%. So this is $22. $22. Yeah. So the amount of cash that you are going to receive from your customer is only 1,078. So this will be a compound journal entry. Cash at bank debit 1,078. Discount allowed is your expense. This is your expense. Debit by 22. And then account receivable. Your account receivable, you reduce the accounts. The account receivable, they make payment. So you're going to credit the accounts by 1,200. So account receivable reduce, expenses increase, your cash and bank also increase.
Sir,
Okay, let us move to the next one. Trade discount. Trade discount is a percentage of reduction granted from the normal list price. Okay. Trade discount are used to determine the actual sale price, therefore are not recorded separately in the accounts. Okay. For example, when you go to Ibnu Battuta mall to buy some stuff, there are a lot of sales now, Diwali sales, Christmas sales. So they have this 30% off. 30% off. They have this 30% off. What does it mean? 30% discount. Okay. The price of the item is 200. Okay. You buy 10 unit and they give you 30% discount. It means that you only pay the 70%, the balance there. So instead of 2,000, you only pay 1,400. Yeah. So this is what called as trade discount. In our record, we are not going to record our sale 2000. We are going to record only what is the actual sale. The actual sale will be 1400 and the account receivable is 1400. The cash or account receivable is 1400. This sale discount is given during the process of selling and buying. We are not going to count the 600 as discount. We're not going to record the 600 here. Just put it here, account receivable 1400, our sales credit 1400. Compared to the previous one, this is cash settlement discount. If you make the early payment, we give you discount, whereas for this one, there's no term for that. This is normally a trade discount. So I'm not going to adjust or include the discount in our account. So we just put it, our sale is 1,400. Yeah. The freight outwards, okay. There are a variety of costs related to moving goods from seller to buyer. So obligation in regard to this cost will vary and are shown on invoice. So we have two terms for freight outward. The first one is X work. X work means buyer have to pay for the shipping. We are not incurring any cost for sending the goods to the buyer. So buyer has to pay for the shipping. Another one is DDP. There is delivered duty paid, where the seller we have to pay for the shipping costs. So if we use this DDP cost, so DDP cost will be treated as selling and distribution cost. DDP cost will be selling and distribution cost. A little bit. Okay. So in accounting, to determine the cost of sales, we have two methods. Okay. Number one is the perpetual inventory system. The second is the periodic inventory system. So under perpetual inventory system, you are going to continuously record the changes of inventories, whereby under periodic inventory system, you will not count, you will not record any changes in the inventory balance or amount. You're going to do a physical stock take at the end of the year to determine what is your balance. Okay. For perpetual, it involves keeping a running record of each purchase and sales. For every purchase you made, the inventory will increase. The inventory level will increase. For every sales, the inventory level will reduce. So the inventory account and cost of sale account is updated. So under perpetual inventory system, we have inventory accounts. Another one is cost of sale, COS. This is your cost of sales accounts. Okay, for every purchase or sales. As a result, the balance in your inventory account is the ending balance of your inventory. So you don't have to worry, because you know every time you purchase the goods, the inventory level will increase, the inventory amount will increase. Every time you sell the item, the inventory amount will reduce. Yeah. So you always know what is the balance of the account. Okay. A stock take or stock count is only performed to verify the accuracy of these recorded ending inventories. You still do the physical check to see whether there are missing items, whether there is any discrepancies between your record and the physical amounts. If the recorded inventory and the stock take differ, then an entry to record the correct amount needs to be processed. Okay. However, for periodic, we are not going to record the changes in inventory in the inventory account. We don't have that process. Instead, we only use purchases account. The account is how much we have spent for purchasing the inventories. We only have one account there. We call it as purchase account. This is two different systems. I'm going to show you both system, how it works. The balance in the inventory account therefore does not change until the end of the accounting period. If your opening balance of inventory is 50,000, it still will be remain 50,000 until you do your stock take. Until at the end of after 12 months, you go and check the balance. For example, the balance now is 80,000, then you're going to update the balance from 50 to 80. A stock take is performed to determine the closing inventory balance. Okay, and this closing balance is then used to determine the cost of sales. So this is the difference, yeah. We use the closing inventory balance to determine our cost of sale under periodic system. Under perpetual system, we keep the record of our inventories and cost of sales, so we don't have we don't have any problem to determine the inventory level and cost of sales. Yeah. So perpetual inventory system is more advanced compared to the periodic, but it depends on the suitability, on the favorable factors. Yeah. uh, because periodic system is much easier compared to the perpetual inventory system. So let us look at this perpetual inventory system. Involve keeping current and continuous record of all inventory transaction. Normally for computer, they have separate files, separate codes for each inventory, and they have the quantity and unit for each inventory and sale. So we have a different code, and then they keep it record for each code, the quantity and units. Yeah, for sale, the sale will reduce the inventory, purchase will increase the inventory. So this they keep it for every record. This is example for one item, refrigerator. The code is 6C350. If you notice, the balance is 4. The balance is 4 here. You purchase 10, the balance become 14. When you sell 3, the balance become 11. When you purchase or when they return it back to you, this is purchase return, the balance reduced to 10. And then finally sales return, when the customer return it back to you, so you have increase in your balance. So we keep the record for every item. This is inventory record cards, or if you use a computerized system, you can track the changes of this inventory here. Okay, so what are the journal entries? If you purchase the items, we are not going to record purchases. We're going to debit. We're going to debit inventories. Inventory increase and account payable increase. Yeah. When you purchase inventories, this inventory is your assets. Yeah. Inventory increase, account payable or liability also increase. If you pay by cash, then your cash will reduce. So this is the journal entries for purchases. Debit, increase inventory, increase account payable. Okay. And then you have to pay, for example, in this question is X work. X work means the seller will not pay for you, so you have to pay for the transportation cost. So debit, freight inward, this is your expense. And if you pay by cash, your cash will reduce. So this is credit, this is debit. I repeat again, X work, the seller will not bear the transportation cost, the buyer has to pay for it. So in this example, we have no choice. We have to pay $420 to transfer the goods, to bring the goods from our seller warehouse to our shop. So that's 420 will be our expense. But yeah. Next, when we sell the item to our customer, for example, 3 units, we're going to record the sales, our revenue increase, and then since they are not paying us yet, so I'm going to debit their account receivable by 3150. So this is the sales. The sales, yeah? The sales, maybe 3 unit multiply by 1050. This is the selling price. This is the selling price. Okay. So you are going to expect to receive money from your customer maybe within 14 days, 3150. What happened to your inventory? When you sell the item to your customer, your inventory value will reduce. So you need to reduce your inventory. Inventory is asset. Now inventory reduce. Okay, you need to credit your inventory. What is the value? 3 times 650. This is the cost, the purchase price. So your inventory now reduce. This is asset reduce, but 11950, and the cost of sale increase. Your cost increased to 1950. Your cost of sales is 1950. Your sale is 3150. If you notice, if you can try to understand this is very helpful for you. Your sale is 3150. The cost for the sale is 1950. The difference is your gross profit for this transaction. So for every transaction, you know what is your gross profit. For every transaction, you know what is your gross profit. So for this sales, your sale is 3150. The cost is 1950. So your gross profit from this transaction is 1200. How do I get 1200? 3150 minus 1950. That gives me 1200. So this is the difference there. Yes, correct, Angie. Yeah. So this is the beauty. This is the beauty of perpetual inventory system. It allow you to maintain record, yeah, of your inventory. Now your inventory reduce, your cost of sale increase, and this is your sale, so you know your gross profit. But the problem is for the sales, you have to record twice. This is one journal entry, this is second journal entry for sales. Okay, give me another 10 minutes. Okay. When you return the goods, this is a purchase return. When you return the good to your customer, okay, when you return the good, sorry, not to your customer, when you return the good to your supplier, this is called as purchase return. Return the good to your supplier, your inventory value will reduce. Your inventory value will reduce. Why? You return the good to your supplier, and your liability will also reduce. Return the good to your supplier, so your inventory balance will reduce, your liability will also reduce. Okay. So for the payment, if we make payment within the discount period, we're going to receive the payment. For example, we make payment for the items here. Our account payable is 6500 minus 650. So this is our liability. We make payment within the period. So we have discount received here 117, and our cash at bank, this is the amount that we need to pay, is only 5733. 5733. Where did I get this account payable from? When we purchase this item, it cost us 6,500. This is our account payable when we purchase the item, 6,500. Okay. When we purchase the item, it cost us 6,500. So this is our account payable. Let me change the color of my pen. This is my, so put it here on the top. This is account payable, 6,500. I return it 650. So my balance is only 5,850. But I made early payment, so that's why I get discount 117. I only pay 5733. So this is the I pay less there because I make early payment. So account receivable reduce. This is discount receive. Discount receive is when we make payment to our supplier. That is discount receive. When we receive payment, early payment from our customer, we give them discount. That is discount allowed. Discount receive, that what we receive, that is revenue. Discount allowed is expenses. So our account payable reduce, our cash reduce, sorry, so our account payable reduce, our cash also reduce, our revenue increase. This is discount given by our supplier. Discount given by our supplier. How about sales return and allowances? If our customer returns the good to us, maybe this is 1 unit. So we're going to reduce our sales. We're going to create a new account, SRA. This is a contra sales accounts for 1 unit. When they return it, you're going to reduce your account receivable by 1 unit. Okay. When you receive the refrigerator from your clients, your inventory value will increase. So one refrigerator costs you 650. So I'm going to increase my refrigerator by that amount. Inventory increase mean debit by 650, and the cost of sale before this already increased, now have to reduce. Why reduce? Because it's a cancellation of sale. So this one reduce in cost of sale credit. Let me repeat again. When your customer return the goods to you, your inventory level will increase. It's a cancellation of sale, isn't it? Your inventory level will increase. So your cost of sale will reduce. Why reduce? Because the customer returned the goods to you. So the cost of sale will also reduce. Your sales reduce, use the sales and return allowance accounts, and then we have cost of sale also reduce by the value, by different value. This is the value for per unit of the refrigerator is 650. Okay, and this is the financial statement for perpetual inventory system. It's very easy, straightforward. This is the sales minus the return. Sales minus the sales return can give you your net sales. This is your net sale, 2,100. And then less cost of sales, 1603. So this gives you gross profit of 497. How do I get this figure 1603? Based on our cost of sales account. Let me go back to the example here. We have cost of sales 1950 debit, 1950 debit. And then we also have our cost of sales here, 650 credit. Okay, going to minus that. And we also have some other adjustment. The 420 is the freight outward. So that's why we have the cost of sale 1603. 1603. That is how we are going to record our that's how we use perpetual inventory system to record our transaction involving retail business.